Welcome back to Alternative Angles, the Fidelity podcast where we hear from investors about strategies outside the realm of conventional stocks and bonds. I'm Steve Rosen, and I'm your host. Johnny Carson once gave a commencement address that resonated with Charlie Munger. The longtime Berkshire Hathaway vice chair was so impressed, he later adapted it for a graduation speech of his own, noting that the comedian's advice echoed that of Carl Gustav Jacob Jacobi, a 19th century mathematician and professor. Jacobi was known to urge his students to invert problems, that is, to think backward from the result they didn't want to help find a path to a solution. And following that same logic, senior classes heard Carson and Munger invert a familiar message. They admitted not knowing of a formula to guarantee happiness or prosperity. So instead, they shared a list of ways to assure misery. And then they told the graduates, avoid the list and you improve your odds of success. A similar principle guides merger arbs, who in their own way invert a familiar stock-picking philosophy. Rather than chasing big winners, they focus first on downside protection to avoid the asymmetrically large losses that come when deals collapse. Historically, that discipline has allowed them to capture profit spreads from the far more numerous set of deals that close, producing a positive absolute return profile with low correlation to other markets. To discuss the nuances of merger arbitrage, I'm joined today by Fidelity portfolio manager Niraj Gupta. Nearly 30 years ago, Niraj earned a degree in chemical engineering at MIT, and then he pivoted to finance, finding his way to the buy side as a merger arb. Here at Fidelity, Niraj works with fundamental analysts, cash and derivatives traders, and a proprietary quantitative decision support system as he strives to deliver persistent diversification and idiosyncratic alpha. During our conversation, I'll ask Niraj to cite historical transaction examples. Bear in mind that all companies and securities named are for illustrative purposes only and are not necessarily holdings of Fidelity products, and reference to them should not be construed as either a recommendation or investment advice. Niraj, welcome to Alternative Angles. It's great to see you.
It's great to be here. Thanks so much for having me, Steve.
Sure. So to kick us off, why don't you take us through your background and explained how a guy who, in inside baseball parlance, earned a brass rat in course 10, and then ended up as a merger arbitrageur.
Sure, happy to do so. For everyone listening, brass rat is the graduation ring that MIT grads wear, and it's that way because the logo is a beaver and it looks like a rat. Beaver being nature's engineer. But as mentioned, I did study chemical engineering. I did also minor in economics at MIT. And while I was there, I was able to take a number of finance classes at Sloan. And, I think I really fell in love with my econ and finance classes. I really enjoyed them. And, this is coming from somebody who didn't know what a stock or a bond was prior to taking any of those courses. And I thought about pursuing a career in finance, or at least trying something out. And a classmate mentioned that if I wanted to have the most intense and interesting introduction to finance, to enter M&A. And so I interviewed with a number of investment banks. I ended up going to mergers and acquisitions, a boutique firm in New York, and ended up doing an analyst program and an associate program in M&A in New York and London. And then went to business school. I was able to study at Columbia, which was really very, very well known for its public investing program. And while at Columbia, I studied with Bruce Greenwald, who was the head of the value investing program there. And we just had a tremendous number of investors come and speak to us in that class. People like Seth Klarman, Michael Price, Warren Buffett. And I think that's really where I caught the public investing bug. So, a few years after business school, I took the big leap and moved to a new merger arbitrage fund. And I joined in 2007, and just before the financial crisis.
Good timing.
Yeah. It was actually, 2007 was a record year for M&A. In 2008, was quite a difficult period, but it was really a tremendous education. And, They say that merger arbitrage is a strategy very much where you want to be taught by somebody who's who's been in the field and seen market cycles. And I was fortunate to have that, with the portfolio manager who I was supporting in my first buy side job.
Oh, great. That's a great opportunity. Before we get into the nuances of the discipline and hear from you about some example transactions and, of course, your approach to the market, why don't you set the table for us with an overview of merger arb?
Absolutely. So I think what might be helpful is to begin by inverting the question and really talking about what merger arbitrage isn't. It's not about guessing the next takeover candidate or trading on rumors. We're not doing screens of what might be likely acquisition candidates. We are really investing in publicly announced situations. Most of the time, those are definitive agreements. These are legally binding agreements that are entered into by a buyer and a seller, and that have been publicly disclosed. So I see it at the same time that everyone else in the market sees it. There are occasionally transactions that we'll invest in that are pre-definitive, but those have to be, in most cases, very well reported. And those reports, there are a very small number of press outlets who would consider credible. People like Wall Street Journal, New York Times, Financial Times, for instance, or if a company has publicly put itself up for sale. So for a transaction, whether it's a stock deal, an all-cash deal, or some mix of the two, the stock price of the company, of the target, will typically trade up to some discount to the value being received. So if we assume an all-cash deal, let's pick a number. If an all-cash deal is agreed to at $50 per share, the stock of the target may trade up to 49, for instance. That $1 spread from 49 to 50 is what I'm trying to capture as a merger arb. And that's the arbitrage spread. We are then trying to understand what the return profile looks like for that arbitrage spread. And we'll look at a number of different elements: the risk-free rate, the deal risk, timing risk. Deal risk and timing risk are somewhat interrelated, but they factor in very important things such as what is going to be required to get this deal that's now been announced and entered into ultimately to closing. And what is that path likely to look like? Is it a 45-day tender offer? Is it a transaction that's going to attract a lot of regulatory and antitrust scrutiny by and which regulators? Often we don't know at the outset exactly which regulators are going to opine on a transaction. So we have to understand the businesses that the parties are in, businesses where they overlap, the dynamics of those industries, and if there are problems that we see, are we going to see it in the same way that regulators will? And are there are some of these concerns resolvable? So we'll incorporate all of that as ARBs. We'll model that deal. We incorporate dividends, financing costs, and for a strategic deal, it's really questions around why is this deal happening and why now? What are the paths to closing? What is the market's view of this deal? And how can I express this as an investment?
Well, with that backdrop, what's your pitch for investing in merger arb to an allocator overseeing a diversified portfolio?
I think the merger arbitrage has been around for many years. Ben Graham actually wrote about it in The Intelligent Investor. One of my colleagues here at Fidelity, Joel Tillinghast, a legendary PM, referred to merger arb as an extreme form of value investing, just with more precise valuation, risk selection, and overlaid with game theory. I think for an allocator, merger arbitrage offers a return stream that's generally uncorrelated to the broader equity markets. It can help reduce portfolio volatility. It's a diversifier. It is really an alternative to fixed income. One of the important things to understand is the merger arbitrage transactions do not, in general, break for for market related reasons. So if a transaction is announced and the market is down 10%, 20%, 30%, there may be stresses within merger arbitrage, but transactions in general do not break as a result of those markets moves. So it is a market neutral total return strategy that relies on idiosyncratic events.
Interesting. You mentioned that it has bond-like return characteristics, yet it's comprised of stocks. It's kind of an interesting observation there. So investing in transactions that close is critical, given that the premium you earn is less than the downside from a deal break. So in light of that asymmetry, what are the risks that you assess to avoid a left tail outcome?
Sure. So one of the first things that I focus on is really trying to understand the motivations behind a transaction, especially a strategic transaction. So what is the strategic rationale for these two companies getting together? That is really going to guide a lot of thinking around the path, the ultimate approvals that are going to be required. So we do a lot of financial analysis where we look at what is the impact of this transaction to the buyer's financials, and then we try to understand really a set of risks around approvals. Approvals in large part are regulatory, and the most important approval in many transactions is related to antitrust. So we will focus a lot on understanding potential overlaps between the two companies. How does this affect the market? How does it affect different markets? Because the approvals are not just U.S. centric in nature. One thing that we've seen in the last 15 years has been the emergence of a number of different regulatory regimes around the world, and that would be in the U.S. and the EC used to be really the only two major players when I entered this business, but we've seen the emergence of antitrust regulators in China, the UK, and really around the world, and as well as here in the United States. State attorneys general are also really focused on antitrust these days. So we do a lot of antitrust analysis, I guess is the way to put it. Then we're looking at other risks related to potential shareholder vote. It's usually not that large of an issue, but it can be in different markets. And we can also, we also try to understand the likelihood of any other interest in the target. So I would say those are, the vast majority of things that ARBs are looking at. There is a lot of legal analysis as well. We do in-depth reviews of the merger agreements. Merger agreements are publicly filed, usually the same day, within a few days of a deal announcement. And they really lay out what conditions are required to close the transaction, what each party's obligations are during the pendency of this transaction. Transactions can take anywhere from, call it 45 days to upwards of a year to close. And again, it really comes, especially for longer dated deals, it really comes down to often how committed the buyer is to closing this transaction.
Okay, so to take us, say, further with these threads, could you walk us through a couple of example transactions from history that illuminate some of these risks and the rewards, and perhaps start out with one that's pretty plain vanilla, where you are highly confident in the outcome, and then others that have more complexity and uncertainty?
Sure. So there was a transaction earlier this year in the summer where a firm called GMS became the target of a hostile approach from another building products company, QXO. QXO has been very aggressive in the M&A market and announced a hostile proposal for GMS. GMS is a distributor of building products, wallboard, things like that. And essentially, one of the first things that an ARB such as myself would do especially in a hostile situation, is to look at the defense profile of GMS. How well is it defended? Is it likely to be sold? Is it likely to be sold to QXO or somebody else? And essentially, a short time afterwards, Home Depot came in and made a proposal, besting QXO to come in at 95.20 a share, if I recall, and Home Depot, which has been really moving into the professional market, announced an agreement for 110 a share. After doing a little bit of work trying to understand Home Depot and their move into serving professionals, it really became pretty clear that this was not really going to face uh, any antitrust issues. And sure enough, so we were able to invest in GMS at a slight discount to that 110 per share, and the transaction closed fairly quickly.
So that could create a nice rate of return, given that the time that you had to wait was short. Now, what about something that was more complicated, perhaps took more time, or was less certain, but ultimately did close?
Sure. So there was a transaction announced in the fall of 2023, where Hess was announced an agreement to be acquired by Chevron Corp. This was a $50 billion plus transaction, combining two very large oil and gas companies, and an all-stock deal. It's where Hess shareholders were to receive 1.0250 shares of Chevron. So I should point out that in most cases, transaction structures can either be for cash, stock, or some combination. So this was a stock swap as opposed to the earlier all cash transaction. In general, a deal such as this would not have been incredibly controversial, and except as an ARB, you have to learn that risks can come out of left field. So there were a few different hurdles that the transaction had to overcome. Number one, there were antitrust hurdles. So this deal received what we call a second request, which is really an in-depth antitrust investigation here in the United States from the Federal Trade Commission. That was one risk, but I thought ultimately could be managed. There was also a risk around the Hess shareholder vote. This transaction was not done at a very high premium. Often you'll see transactions, the average premium, M&A premium, has tended to be around 30, 35%. This was a very low premium transaction. And there were some shareholders who really felt that Hess had undersold itself. The argument from Hess was that as an all-stock deal, we would be able to participate in the upside via Chevron stock. But the biggest out of left field risk came about 5 or 6 months into the transaction, when Exxon, another giant in the space, announced that it was challenging the transaction based on a right of first refusal on an asset that Hess was a JV participant in on the offshore of Guyana. So I'll take you back a little bit. Hess, Exxon, and the Chinese National Oil Company found an oil field offshore Guyana called the Staybrook field, which was really just starting to become very productive. And Exxon did not want Chevron to come in and replace Hess. And this transaction essentially was delayed by over 1 year because this right of first refusal had to get adjudicated by an arbitration panel. It was probably one of the most fascinating examples of a left tail risk that I can recall, given that it was three very large American oil and gas companies fighting over an offshore asset, off the coast of Guyana. that was being adjudicated by the International Chamber of Commerce, a French organization in London. It really took a lot of twists and turns, and the transaction ultimately closed earlier this summer.
I'm curious, during those twists and turns, did the price of the target move around, giving you perhaps an opportunity to capitalize by buying lower?
Yeah, the spread on this transaction really widened a lot during the pendency of the transaction and gave us a lot of opportunities to trade that spread. So, the spread, which is the discount to the value that shareholders are receiving, moved from the $8 to $10 range out to $20 at some point, and I believe exceeded $20. So that was it really presented opportunities to to set spreads much wider. That $20, if you set a $20 spread, you're essentially hoping that upon completion of the transaction, you will make $20. And that was roughly about 7 or 8% of a gross spread, if I recall correctly.
Okay. Now, what about a deal that didn't happen ultimately?
So we had a couple of antitrust challenges to transactions in 2024. I'll take you through one of them, but both of them were in the retail space. Both of them were challenged ultimately successfully by the Federal Trade Commission. One was the acquisition of Capri by Tapestry, two fashion companies, and the challenge was really trying to adjudicate handbags and mid luxury handbag market. The other transaction that was unsuccessful was the acquisition of Albertsons by Kroger, and this really was a very sort of meat and potatoes antitrust analysis, where you had the way that the Federal Trade Commission has looked at supermarket mergers for many years has been to look at geographic overlaps of those markets. And you may think that's easy enough, but there are questions about what constitutes a market, given changes in shopping habits, what companies would constitute adequate replacements, adequate substitutes for each of those companies. And for those of us who do the grocery shopping, I know in any given week, I may go to Trader Joe's, I may go to Costco, as well as Whole Foods, and then there may be online ordering as well. And so these were all arguments that the parties made in court. Ultimately, the Federal Trade Commission defined the market as supermarkets within a certain radius and viewed the divestitures that were being offered by the companies as insufficient to replace competition. And a court agreed with them, and the transaction was called off in late 2024.
So in that case, those who bought shares of the target might have been disappointed because perhaps the price fell when the deal was called off.
Correct.
All right. Now let's steer more towards your approach. So tell us about your investment philosophy, and to the extent it was influenced by your prior experience and background, that'd be great to hear as well.
Sure, absolutely. So I think one of the really important things in understanding a merger situation is really focusing on the strategic value that a target is bringing to an acquirer, and that involves a lot of fundamental analysis. So there's financial analysis that we do around valuation. It involves antitrust analysis. It involves understanding the different products and the different participants in a market. Merger arbitrage is a very research-intensive, actively traded strategy. We incorporate options trading, and I spent a great deal of my time focused on the downside. In merger arbitrage, it is not uncommon for us to risk 10, 20, $50 to make one. And so we need to be very, very confident in our downside estimates. And that is not just where what we think fundamental fair value is in a transaction, but really incorporating the changes in the marketplace, the shareholder base, looking at technicals as well as fundamentals, and trying to forecast where a stock, where two sets of stocks may trade on a break. And the way I really think about it is, if I saw a headline come across my screens saying that XYZ transaction is terminated, out of the blue, where would each of those companies involved in the transaction trade to? And so that jump to a termination event really guides the position sizing. It guides what is attractive or not in the universe at any given time. Merger arbitrage is a somewhat reactive strategy in the sense that we are looking at a pretty defined universe of transactions. In the U.S., for instance, if we looked at North America transactions, at any given time, it's probably not more than about 100 transactions that we are sifting through, and we're investing in maybe a quarter to a third of those transactions at any given moment. So we're really looking at what is being implied by the market in terms of the probability. How does that compare to the current universe as well as historical universe, and trying to understand what the next catalyst is that will make a spread tighten or widen.
Now, to hear a little more detail about your process, how is it influenced by the resources that are at your disposal here at Fidelity?
Sure. So I think one of the tremendous things about doing merger arbitrage at Fidelity is really having a wealth of resources. That includes other portfolio managers, other analysts who are almost always going to be more expert in their industries and their companies than I am. On any given day, I may be looking at a biotech transaction, an industrials transaction, a telecom deal. It really runs the gamut. We are industry generalists, so I'm able to share information in terms of what I'm seeing in the market, but really pick the brains of a ton of very talented people here at Fidelity. And I think that is, far and away gives us a tremendous advantage and skill that I'm thankful for. I think other advantages that we have here would include the access that we have to companies. We have companies that we meet with daily, and as a portfolio manager, I'm able to participate in those meetings, and I get a sense of what areas of interest a buyer may have, what transactions are, potentially interesting to certain companies, and that really comes into when we're looking at overbid situations. And then we just have a treasure trove of data, that we've really that we've collected. The firm has been in business 75 plus years. It's really well regarded as one of the preeminent fundamental firms on Wall Street, and that has been a tremendous source of informing my investments and hopefully adding value for our shareholders.
Yeah, sure. I think that, as you point out, the combination of the data sets you have here, your knowledge of merger arb, but then also the fundamental analysts who are experts in their industries combines to hopefully produce a nice result for your investors.
Right. And given the focus that merger arbs have to have on downside analysis, I'm able to really bounce ideas off of the analysts and PMs, and ask them for where, for their estimates of fair value. And those tend to be longer term estimates of fair value, but they are incredibly informative to someone in my seat.
Okay. So as you sift through this, it's the case that at a point in time, the number of merger transactions in the market may be small, perhaps a handful to a couple of dozen, suggesting your investment opportunities are episodic. So to me, that means you have to have cash at the ready when opportunity knocks as you manage your funds. So how do you stay invested, and how do you maneuver through such an environment?
Absolutely. I think one of the important things in investing, generally speaking, is to not swing at every pitch. And one of the key tenets is to wait for those fat pitches and to be in a position to capitalize when there are corrections in the market or there are are discontinuities in the market. And so we are broadly invested across a number of transactions, but we are certainly not chasing. And we want to make sure that if there is a a deep market sell-off or there's a break in a transaction that may affect the broader universe, that we have the ability to play offense.
Yeah. So as you cull through the opportunity set, are there specific signals that might make you more or less likely to invest?
So I do look at the entire universe on an aggregate basis. We look at what gross spreads, what annualized spreads look like at any given moment. We look at what the market implied probability is telling us at any given moment. And like most investors, we're informed certainly by what's going on in the macroeconomic environment. But eventually, at the end of the day, each deal does stand on its own, and we are, when we try to assess each deal on its own merits. There is if I look at my portfolio, I certainly cut the risks different ways. I may try to look at how many transactions at any given point are leveraged buyouts, how many transactions are subject to second requests or subject to geopolitical risks. So we do look at, we certainly look at the different risk buckets, if you will, but we want to make sure that we have the ability to invest if there's a dislocation in the market.
Okay, so staying on this notion of portfolio construction and risk, how do you build conviction to size positions appropriately in order to manage the risk?
Sure. So I am an engineer at heart. Once an engineer, always an engineer. So
that's what I say too. Given that I worked 2 summer internships as an engineer, but anyway,
I worked one, so you have me beat, Steve.
Oh, okay.
But I can't stress enough as a process engineer, especially how important it is to have a process-oriented framework for making decisions, constructing a portfolio. And when we begin our work, we have standardized templates to ensure that each deal is analyzed through multiple lenses: financial, legal, regulatory. It's almost like a checklist, if you will. And we want to make sure that we are not leaving any stone unturned. We spend nearly all of our time on the rest of the process in the rest of the transaction, really looking at fundamental structural analysis, trade construction, portfolio monitoring, and risk management. And in terms of trying to create the book, we will also try to shock it. Merger arbitrage beta. So that means how the merger arbitrage market moves with other markets. In this case, let's use the S&P 500 as a proxy for equities. It tends to be close to zero. Now, in extremely stressed markets such as 2008, 2020, even 2022, and that beta does pick up a little bit. That being said, merger arbitrage beta has been low for decades because deals don't break typically for market-related reasons. Deals break for idiosyncratic reasons. Even in 2008, according to one HFRI merger arbitrage index, the merger arbitrage market, broadly speaking, was down about 5% when you had the S&P 500 down nearly 40%. And that was actually the only down year for the strategy in the last 20.
Well, it's an enviable record. A little while ago, you, in passing, referenced the macro environment. And I'm curious, are there certain investing environments that positively or negatively affect opportunities for merger arbs such as yourself?
Probably one of the most important factors contributing to the merger arbitrage environment is the deal universe, the size of the deal universe. And it may be counterintuitive, but we tend to see much more M&A activity in bull markets. And you may think, well, don't buyers want to pay less for a company? That's somewhat true, but sellers don't have to sell, and buyers can also use their stock as currency to do a transaction. So, one of the most important things is the health of the economy, the health of equity markets and financing markets, all of which feed into an M&A decision. I like to point out to people that certainly on the sell side, but even many times on the buy side, an M&A transaction is one of the most significant decisions a management team and a board of directors is going to make, and they really need to have confidence in the economic environment that they're in and that they're likely to be in for the next few years, and that really affects the volume of M&A. I think that's one of the key inputs into the universe that I'm evaluating daily.
Okay. Now, as we get closer to time, I just thought I'd wrap up with asking you about your outlook and what you see coming down the road.
We just wrapped up the third quarter of 2025, and it was actually the most active M&A quarter that we've had in a number of years. So I'm incredibly bullish about the strategy. I think we at Fidelity are able to really have our finger on the pulse of what companies are thinking about. The strategy has really evolved over the time that I've been in merger arb, nearly 20 years, and I think it's a well established approach. It is a complex approach, and it's something that I think are well suited to participate in at Fidelity and succeed in, given our focus on fundamentals, given our focus on being here for the long term. I'm incredibly bullish about the strategy going forward.
Well, great. Niraj, I really appreciate the time. It was great to talk to you. I learned a lot about merger arb, and thanks for stopping by.
Thank you. It was great being here, Steve.
This podcast is intended for institutional investor and investment professionals only. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or a solicitation to buy or sell any securities. Views expressed are as of December 2025, based on the information available at that time, and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services and may receive compensation, directly or indirectly, in connection with the management, distribution, and or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all of the particular facts and circumstances of you or your client's individual situation and reach out to an investment professional if applicable. References to specific companies or investment themes are for illustrative purposes only and should not be construed as recommendations or investment advice. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. The securities mentioned are for illustrative purposes only and not necessarily current holdings invested by FMR LLC. References to specific issuers or securities should not be construed as recommendations or investment advice. This piece may contain assumptions that are forward-looking statements, which are based on certain assumptions of future events. Actual events are difficult to predict and may differ from those assumed. There can be no assurance that forward-looking statements will materialize or that actual returns or results will not be materially different from those described here. Alternative investments are investment products other than the traditional investments of stocks, bonds, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are: alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. Stock markets, especially foreign markets, are volatile and can decline significantly in response to adverse issuer, political, regulatory, market, or economic developments. Foreign securities are subject to interest rate, currency exchange rate, economic, and political risks. Securities selected using quantitative analysis can perform differently from the market as a whole as a result of the factors used in the analysis, the weight placed on each factor, and changes in the factor's historical trends. Securities lending involves the risk that the borrower may fail to return the securities loaned in a timely manner or at all. If the borrower defaults on its obligation to return the securities loaned because of insolvency or other reasons, a fund could experience delays and costs in recovering the securities loaned or in gaining access to the collateral. The H4I Event-Driven Merger Arbitrage Index is a benchmark that tracks the performance of hedge funds using merger arbitrage strategies, which primarily involves investing in the equity and equity-related instruments of companies undergoing a corporate transaction. The S&P 500 index is a market capitalization-weighted index of 500 common stocks chosen for market size, liquidity, and industry group representation to represent U.S. equity performance. Past performance is no guarantee of future results. Investing involves risk, including risk of loss. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services, LLC members, NYSE, SIPC, and institutional advisory services through Fidelity Institutional Wealth Advisor, LLC. Copyright 2025, FMR LLC. All rights reserved.